Okay, so welcome back to our discussion in Chapter 10 of Differential Analysis. We're going to look at another scenario. I think we have two left that we'll discuss. The next one is replacing equipment. So this happens when you have a piece of machinery that you've been using for a while and you have to decide whether to continue using it or to invest in a brand new piece of machinery. What's more worth it, right? To buy or to keep? So let's look at this information. They are telling us the machine we currently have, which is an older machine, has a book value of $100,000. Remember what book value means. We discussed that in an earlier screencast at the start of the chapter. That is the cost for the machine less accumulated depreciation. We also said something else about the book value. Is book value relevant to our analysis when we're deciding upon which alternative to choose among two? No, it's not, right? The book value is a sunk cost. It happened a long time ago. We paid the money for the machine. No matter what we decide to do now, we're not going to recoup that money. So since it's not going to matter to us, it's not going to affect the financial dollars in and out as a result of this decision, we're going to just ignore it. All right. So what else do we know? We know the estimated annual variable manufacturing costs. So every year, if we keep this machine, we are going to spend variable manufacturing costs of $225,000. If we sell it, we could receive from a buyer $25,000. And it's expected that even if we do keep it, we will keep it for 5 more years. Well, what about the new machine? Well, the new machine will cost us $250,000 out of pocket to buy it. Now, if we have a brand new machine that's working really well, our variable manufacturing costs are only $150,000. That's much different than this $225,000, probably because we have a brand new machine. There is no residual value, meaning at the end of the life of this machine, it's not going to be worth anything to us. And the useful life is also 5 years. Okay, so let's put this in a differential analysis. So if we look at this, let me make this bigger here. If we look at this and we compare our two alternatives, continue with the old machine or replace it with a new machine. All right, continue with the old. Well, we won't be able to sell it, so we'll get $0 from the sale of it. We won't have to buy a new one, so that'll be $0 out of our pocket, but we will still have that $225 a year variable manufacturing costs. Over 5 years, that's going to cost us $1,125,000. If we replace the old machine, well, then we'll have $25,000 coming into our pocket from its sale. We'll have to spend $250,000 for a new machine. But down here, our variable manufacturing costs, I think it was $150 over 5 years, will be $750,000 over 5 years. That's a big difference. So if we go ahead and do our differential analysis and we subtract alternative 2 minus alternative 1, these are our differences, showing us a difference in income of $150,000. And we can see that replacing the old machine provides a $150,000 benefit to net income over continuing with the old machine. All right, so that is your differential analysis for the scenario of continuing or replacing a piece of equipment. There is a weakness with the differential analysis, and it's this. There's a couple of things. Let's talk about opportunity cost first. So I said in the previous example, we are either going to keep equipment or buy new equipment. Well, that's really kind of making it extra simplified, and it's not always the case, right? There may be even other options. That money we were going to use to buy the machine, that $250,000, that could be used towards other projects or other assets. which would benefit us even more. So we're ignoring the opportunity cost implications in these analysis, and we're just trusting that the problem wants us to only consider the two alternatives in front of us. So instead of taking that $250,000 and buying new technology or investing in stock somewhere and possibly earning even more money, we're ignoring that. We're going to say, this is the only thing we're considering doing with the money. So opportunity cost is money, right, that you are foregoing to use for something else. All right. If you read this bullet, and that's probably the best way to understand it, revenue that is foregone from an alternative use of an asset such as cash is an opportunity cost. Okay, what else could we have done with that money? We're not considering that. All right, one last scenario, and that is accepting business at a special price. That means, so you have a company that manufactures an item, and they get an offer from some other entity where they want to buy a bulk of your product, but they want to buy it at a price lower than what you would sell it for in the stores. So let's look at an example. Actually, we go straight to the example. Okay, there's B-Ball company that makes basketballs. They have the ability, their factory has 12,500 basketballs, to make 12,500 basketballs. That's how much their machines, if their machines work to full capacity, if they have people on at full capacity and they buy all the materials, that is the most they can make. Currently, they are selling 10,000 basketballs a month. So that's telling us that they still have room here. 2,500 basketballs every month. They could still continue to make. They have room to do that even though they're not selling them. They normally sell each basketball for $30. And here's the costs. The variable costs are $12.50 and the fixed costs are $7.50. So my total cost to make a basketball is $10. I sell it for $30, so I have a gross profit of $10 per basketball. On March 10th, B-Ball gets an offer from an exporter, and they're saying, we will buy 5,000 basketballs from you if you will accept $18 each. Now, B-Ball knows I have the room here. I have 2,500 basketballs extra I could make a month and not interfere with my current sales. These 5,000 basketballs will be accepted over 3 months, so that's great. I could do 2,500, 2,500, and be done in 2 months. So they have the ability to make it. Is it worth it? Let's look at the differential analysis. If they decide, nope, we don't want to do it, then guess what? Your revenue and your cost and your income, this is an easy one. It's all zero. Everything is zero. If you accept the order, then right here, if you look at the little asterisk, you're making 5,000 basketballs at $18 each. You'll bring an income of, or revenue of $90,000. Your costs, and here's the thing to consider. Let's go back to our costs. Our variable costs are $12.50 per basketball. Remember, variable costs. The more I produce, the more variable costs I have. So I will have variable costs in the amount of 5,000 times $12.50. Okay, here that is, minus 62,500. But what are we missing here? What costs are we not counting? Well, we're not counting the fixed costs. And why aren't we? Because whether we reject the order or we accept the order, those fixed costs remain. They are not influenced by the level of activity. They are still going to be there. They're not going to go away. The only thing that would change is fixed cost per unit, right? But in total, we won't be saving any money. So if we compare these two rows, obviously it's showing us that we would still make some money. 27,500 is better than zero, and we have the capacity in our factory to make those basketballs. Let's do it, right? Let's make them. So that one's kind of a no-brainer. One thing I want to say, and that's the last scenario, and you could go through the problems in your homework, which cover all these possible scenarios. There is, as we go through these problems, the math probably seems simple. What I want you to focus on, because when you're given a test, it's not going to say, okay, now we're discussing to the make or buy scenario, or now we're discussing discontinue a product scenario. You have to be able to identify what's going on in the special consideration in the math. So just like we did here where I said exclude fixed costs, you'll have to know when you're doing an analysis on accepting new business at a special price that you exclude fixed costs. When you go back to, let's say a scenario like, what came before? We skipped process or sell, by the way. Let me think of a good example, right? You have to know what is a sunk cost. You have to know to ignore those. You also have to know, like discontinuing a segment, that fixed costs in your analysis will be present in your analysis and they will remain even if you discontinue an item. So it's those little considerations, even though the math seems simple, looking at it, please practice and familiarize yourself with. Okay, that's basically it for this chapter. And if you have any questions, send me an email and I will answer you pretty quickly. So just get in touch with me and we can discuss whatever remaining questions you have. I hope everybody has a great day. Take care.